Hey guys, Doug the Retirement Guy. We got a review here. Capital Southwest Corporation Common Stock, better known as CSWC. Is this good for a retirement account? It's funny, we started looking, trying to see if we could bump up our dividend yields in our accounts. So we started looking heavily into a lot of different funds, and we found this one, and it was very interesting. So I wanted to let everybody know about it and see if this can't help other people as well. CSWC, Capital Southwest Corp, common stock. Again, this one here, they're internally managed, credit-focused business development company, a BDC. So it didn't shock me when I saw the 13% distribution rate when we're looking at BDCs. Very, very common high returns because they have to give up at least 90% of their profits back as dividends, per the rules and per things for the tax rates and so on. So their team is really developed on, they have a set process. What they do is they are looking to build relationships. Once from relationships, they build into the credit bureau. They continuously just grow and grow and grow on this side of it. Some of the highlights that we have, they're invested right now in over 178 different companies. Majority of it is all first lien senior rights. So that means if someone comes in and the company for some reason has to go belly up, they're the first one to receive as much as they possibly can in the majority rights. The other thing is, it's very hard trying to show 178 different companies on here the way they've done it, but they are well diverse in multiple different areas. So we're not worrying about the tech stocks that dropping off, or we're not worrying about healthcare. We're not worrying about consumer goods with tariffs. These guys are so well diversified that they have a good platform to work from. So you're going to ask, why CSWC? Well, first off, 13.31% got our attention immediately. I said, if we can get a 13% return on dividends, let's find out how solid is the company. Are we going to have to give a lot of our money away to get the 13%? Because 13% in a BDC, very common, but we got to make sure they're a solid built company. They offer a quarterly dividend payouts, and this is what happens when you start digging deeper and deeper. You're going to end up have to give up something that you love, which personally love to death, monthly payments. But we're also building a platform where we can build quarterlies out and fixing months that are down. So we were okay with this. The profit ratio of 13.76 when most BDCs are at 17.22. So it tells me that they're basically pricing themselves at a lower rate than most BDCs, which, the market's telling us there's a reason for it. But I like that there's going to be some massive growth off of this fund. And what they told me was a 1 year target is about $24, which has basically a 24% increase option in market value. So 13% plus maybe a 24% could be a 37% gain. This is interesting and kept us going. Now I sat down and said, hey, what is the ratings of this? And we've really got some interesting stuff. And that came into A+ rating for safety. Their dividend safety, the company has a cap of $957 million out there. Their yield is in the top 15% for dividends. So you get another A+ in this one. So they're rating us at 12.19%. Now, knowing me, you'll probably catch on quick. As soon as I see numbers that don't jive, my question is why? And the answer come back to is specialty, yearly, and distribution payouts. So it depends on how great of a year they have that they increase their dividends, but they're guaranteeing or pretty much planning on a 12.19 forward yield, which puts them in that top 15%. Another positive. 1.1 beta, it's in line with the direct price swings, so we're not seeing huge price swings up, down, every which way. But this is the one that added to it. 26% target price upside from the current selling side that they're at, which they say is mid 20%. Well, we're seeing this because of the sell off of everything going on with these tariffs and the stock market's doing what they're doing. But this thing is showing, guys, another 26% growth. As I said earlier, the target at $24 was a bigger number. This is even larger. The return on CSWC. So right now, in 1 month, they're down 11.16%. 6 months, they're down 23.74%, and that gives them a year to date of 11.69. So it tells me here right off the bat, I'm going to say last year they were starting to lose, and then they lost big in the last 30 days, which is equals out to their year to date. They've washed everything gains that they've had in the last month. 1 year they're down 21.38, and 5 year they're at 1.73 gain. Now, this stock has been out there since 1985. So they've seen a lot. They've seen a lot of the changes. They've seen the housing market issues. They've now seen the tariff issues. They're seeing a lot of different things going on. But these numbers do not impress anybody. These numbers tell you to run, get away. And so I'm looking at some big positives from other areas, and I'm seeing negatives here. So I got to start questioning which way are we going to balance this thing, right, wrong, or indifferent. So what I did is, again, I put this in the $10,000 category back, a year ago. $24 share stock, $10,000 into it. We bought 410 shares. We get rolling off of this, and you can see quickly that basically from October on, it's been losing and losing and losing. It's been preparing that way. They're still paying their dividends because they're dialed in for that. And that's the other big thing they have. They are dialed in for the next 2 years, which basically with 58 cents a share every quarter. But their stock is down 8.73% in 12 months, and they're down 21.97% over the 13 months. I understand this as the tariff scenario, the stock market doing what it's doing, we're going to see a big drop off. But why do we keep seeing a drop off from October on? The dividend stayed at $9.75, but I only got basically a 9.76% return off of those dividends, not the 12 or 13% they were talking about. So basically over 12 months, we have a 1% total return, or $102 from our investment. So it's not really strong, not great, but we're looking on this one down-term, long-term future. Because here's look at the price line over time, and again, it gets right into that same little market. This thing seems flat, seems fairly smooth, but with a slow drop off. I do not like to see slow drop offs. I don't like to see any drop offs, but we're seeing this thing has not had the massive drop that we've had before. It's been steadily dropping since October. So where we get this from, it means the average price is $23.91. Current cost today, $19.03. That's a 20% below average sell. So the question is, now I can see this is getting down to its 52-week low. It's not dropping any lower. It's starting to flatten out. And we're going to get into that 26% gain of growth, just getting back up to the average that they're talking about. So is this, yes, good for a retirement account? I say yes. It's time to buy this stock and do it accordingly. You have a good dividend, 9.75. If they add in their bonuses that they talk about, you're going to get higher than that yet. Plus, it's on a 2-year increase of their dividends. So for the next 2 years, they've increased their dividends every year. Now, the 1-year forecast, as we talked about, 24% increase, that's a 26 upside moving forward. So even though the numbers and performance of it don't look as strong as we do with many, many other stocks, but this one has a little bit weird scenario and vibe, is everyone's telling me the same thing, that this is a stock to invest your money into. It's the buy now type situation. The dip is in, invest into it, because the fundamentals of the company are there and everything seems to be going right. except the returns from the market doesn't like what they're doing. And they said, you can't argue with the numbers. You can argue opinions, you can argue your choice, but overall, you can't argue with their numbers, and their numbers are solid. Guys, this is Doug, the retirement guy. I hope you like the videos we're giving you. We are trying to continue to grow this site and give you guys what you're looking for. If you like what you're seeing, give us that thumbs up. If you hit that subscribe button, don't miss any of our videos that we're producing for you. And if you have any comments, put them down below. Love to hear what your opinion is of this. Everything helps the channel grow. We appreciate it. We'll see you next time.